In this session, we look at different approaches to strategic planning. In particular, we will look at the incremental approach, the emergent approach, and the impact of competition on strategy. Before we do this, let's first look at the 5 P's of strategy. Now, we all know the 4 P's of marketing. The 4 P's of marketing are different from the 5 P's of strategy because the 4 P's of marketing are about 4 different functions of marketing. The 5 P's of strategy are about 5 different ways of looking at strategy. Okay, let's look at the first one, plan. Strategy is looked at as a plan. It's a plan of action. Or strategy is looked at as a ploy. A ploy meaning a maneuver. It is looked at as a way of creating an impression on somebody, creating a expectation that something will be done, right? A maneuver. 3, strategy can be looked upon as a pattern. What is your strategy? Meaning, what is your way of behaving? That is the 3rd way of looking at strategy. The 4th is position. That is, when you ask a question, what is your strategy? What you are really asking is what is your position? What is your stance? What is the stance that you have adopted on this particular issue, for instance? That's what you're asking. And the 5th way of using the word strategy is as a perspective. What is your strategy? Meaning, what is your way of looking at issues? Okay, so these are 5 different ways with which strategy is looked. These are 5 different meanings given to the word strategy. Now, Professor Mintzberg, who is like Professor Porter, one of the very respected figures in strategy, Professor Mintzberg points out that the first P, that is, looking at strategy as a plan of action, is perhaps the most useful way of understanding the concept of strategy. Now, strategy, as we saw, is a complex activity. It's not surprising that there are different types of strategy. For instance, you have planned strategy. Now, planned strategy is documented strategy. It's imposed from the top. It's strategy which has been documented by a small group of people and has been imposed from the top. Then you have entrepreneurial strategy. This is very typical in the case of organizations which are in the process of growing up, when the first entrepreneur is actively involved in management of the organization. The entrepreneur has a lot of assumptions, and he has a lot of strategic pointers in his mind. However, these are not made explicit. So, entrepreneurial strategy is very different from planned strategy. And then you have ideological strategy. See, ideological strategy is a company strategy which is based on shared values. Perhaps the best example for this in the Indian context is Infosys. See, Infosys was set up by 6 people who were not related to each other, they were people who had worked together. They were people who had certain shared values. So the strategy of Infosys is ideological. Then you have disconnected strategy. This unfortunately is very common in industry. Here is a situation where different parts of the company behave in different ways. It is as though different parts of the company had different strategies which they were following. That's disconnected strategy. And then you have consensus strategy, which is strategy evolved through dialogue. So amongst these different ways of strategy, amongst these different types of strategy, obviously strategy evolved through dialogue. The consensus strategy is the most appropriate way of arriving at strategy. Now, some people believe that in a rapidly changing environment, rather than trying to catch up with the environment, what the company ought to be doing, what companies ought to be doing, is focusing on their competence. After all, competence is a matter of looking at internal issues, issues which are within your control. So what they say is that strategy is based on competence, right? For instance, a company like Philips, right? Philips has tremendous experience in the manufacture of electronics products. So Philips' strategy has always been to build on this expertise, to use this expertise in the consumer electronics sector as well as in the hospital electronics sector, right? So Philips is an example of a company where strategy is based on competence, the competence to handle electronics, the competence to handle a certain kind of technology. Now, another company of this type is MTR. MTR, as we had mentioned in one of the earlier sessions, is a food group based in Bangalore. Now, MTR had a restaurant in Bangalore which used to be the favorite haunt of all visitors to Bangalore from other parts of India for good, proper South Indian food. This MTR success story was based on the talents of individuals within MTR who were able to produce day in and day out food of a certain kind of food with a certain kind of consistency. So the story of MTR is again the story of building on competence. The MTR went from one kind of product to another, all based on its competence in the food arena. Now, let's look at telecom companies. This is a very interesting example because see, telecom companies in India particularly, mobile telecom companies, if you really look at what is their business model, you will see that it's a model which is based on putting together a large number of small bits of revenue. A large number of small bits of revenue. Now, we'd mentioned earlier during this course that the typical Indian consumer tends to be very cost conscious, and what is called ARPU, that is ARPU, average revenue per user, the average revenue per user of a telecom handset in India is very low. Therefore, a telecom company can prosper only by having a business model which allows it to effectively, efficiently, economically manage the collection of large bits of small cash and put it together. This expertise which the telecom companies have gathered can be put to good use when it comes to mobile banking, particularly mobile banking in the rural areas. Now, what is mobile banking? Mobile banking is giving the consumer an opportunity to draw funds and to transfer funds using his mobile. Typically, in the rural areas where mobile banking would have the most advantage, because bank branches are few and far between in the rural areas. Therefore, mobile banking would empower, would liberate a large number of potential consumers and draw them into the economy. In rural areas, they would be using this mobile banking to transfer small amounts of money at any given point in time. So, the ability to handle small transfers, the ability to handle small bits of money, which the Indian telecom companies have demonstrated over the last 10 years, this ability will stand them in good stead in mobile banking. And that's the reason why some of the largest Indian mobile telecom companies are now actively negotiating with the government to move into the area of mobile banking.